Greetings, everyone. I'm David Darst, Senior Investment Strategist for Petiole Asset Management and the Family Office. Welcome and Ramadan Mubarak to everyone as we enter this season of religious observance. We've had quite a few developments in the financial markets, in the banking sector, regional banking sector, community banking sector. We're facing Federal Reserve meeting today. We have a decision on interest rates. We have the dot plot. We'll get the summary of economic projections at the end of today's meeting. Of course, people are talking about quantitative tightening and quantitative easing with some of the rescue measures that were implemented last week. We are calling, some members of Congress are calling for the expansion of deposit insurance. Not sure if that could pass Congress or not. You have Jamie Dimon, who's the CEO of JP Morgan, as you know. He's leading efforts to stabilize First Republic Corporation. Lazard has been brought in to pursue and analyze strategic options. Yesterday, we had the largest decline since 2008 in the two-year Treasury yield. It went from 392 to 392 from 417, 25 basis points, the largest single day jump, I should say, 392 up to 417. We've been faced with regulatory action. We're going to basically turn it over and begin our webinar today. And we're very, very blessed and honored and thrilled to be with Drago Kolev, who's a longtime friend and colleague. We've traveled together in Europe and in the Middle East to visit with investors. As many of you know, for the past 24 years, Drago has been intimately involved as an analyst, as an investment banker, as a senior executive in the Merrill Lynch Bank, where he was head of portfolio strategy. And this is a perfect time with all that's going on in this contextual environment to look at where we're going and how can we take advantage of this situation. The First Republic Corporation, the stock rallied 29% yesterday to $15.77 a share. However, over the past 12 months, that stock has ranged between $171 a share and $11 a share. So a big move up in one day to 15, but look at that range. The KBE Bank Stock Index, which is the 24 largest banks, that's not regional banks, that's not community banks. It rose 5% yesterday. It's down 17% for the year. And the regional bank index, which is KRE, not the KBE, it was up 5.8% yesterday, and it is down about 21% year to date. So this is a perfect time to benefit from the experience, wisdom, and hands-on experience of Drago Kolev. And would love to start out, Drago, by asking you how you and Petiole first got involved in community banks. Well, welcome.
Thank you, David. It is such a pleasure and such an honor to be talking with you today. And also thank you to our listeners that have tuned in. I started managing money for the family office and its predecessor in its sister company, Petiole, in 2011. The U.S. economy was coming out of the global financial crisis, and loan losses had wiped out the equity of many banks. And regulators were knocking on their doors, asking them to raise equity and replenish capital levels. And they actually weren't knocking on the doors of the management teams. You know how management teams are reluctant to issue dilutive capital. The regulators were sending these nasty letters to the board members of the banks, telling them that they have 5-6 months to raise capital, or else, if they didn't succeed and if the bank failed, the board members would be liable for the failure with their personal assets. So as you can imagine, there were a lot of boards out there that were very eager to raise equity at pretty much any price. And the big names, the ones that are in the headlines, were of course able to access capital markets, but the smaller names, the community banks that nobody had ever heard about, they had a much tougher time raising capital, and we saw an opportunity there. We started making calls to hundreds of small banks. We ended up investing in about 30 of those at very attractive valuations. Again, there wasn't really a line of people at the door waiting to give them equity. We were able to get very attractive prices, give them capital, equity to recapitalize, and the strategy worked extremely well. By the time we exited that portfolio, we earned 21% annual return for our investors, and that's how we first got involved in the community bank space.
Drago, community banks, we talk about regional banks, we talk about money center banks. How can you distinguish the role and position, function and mission of community banks? Can you elaborate?
Yeah, you know, David, you like history, so you're going to like this one. You know when the first central bank in the world was established? It was the Riksbank.
Was that 1690? Was it 1693? Was it the Bank of England? No.
I thought so too, but it was actually Riksbank in Sweden in 1668. Bank of England was the second one. It followed in 1694. But by the 19th century, all the major European countries had established their central banks. And here in the US, where we not only drinking bad coffee, but we had this Jeffersonian distaste of central government and several attempts to organize a central bank in the US actually failed in the 18th and the 19th century. The Fed didn't get established until 1913. So for the longest time, basically, in the US, we had no authority whatsoever to issue national banking licenses, and bank charters were issued by the individual states, and banks couldn't really do any business across state lines. And as a result, we ended up with one of the most fragmented banking systems in the world. 100 years ago, when the Fed was established, in the US, we had about 30,000 banks. Now that number has been dwindling over time. 40, 50 years ago, we had 15,000. Today, we have about 5,000. But still, we have one of the most fragmented banking systems in the developed world, with a lot of independent small banks that focus on their local communities. So if you take the tiering, if you wish, by size of the bank system today, on the top you have the SIFIs, right? The systemically important financial institutions that get their own separate set of regulations. Those are the JP Morgans of the world with 250 billion plus in assets. Then right below them, you have the regional banks between, let's say, 50 billion and 250 billion in assets. Then between 10 and 50, you have the smaller regionals. And below 10 billion in assets, that is where the community banks sit, the smallest banks in the country with less than 10 billion in assets. We have 4,700 community banks in the US today. And about 700
That's
of them,
a lot.
700 of them have a ticker.
4,700.
Yeah, the 700 of them, interestingly, have a ticker. You can go buy them on an exchange. You can buy them over the counter. And this is the subset where we find some very interesting investment opportunities today.
Why would customers use a community bank in today's world, Drago? What are the functions? What are the special competitive advantages of a community bank, and what are the services they're offering to an individual or a company, a community bank, as opposed to these larger regionals, the smaller regionals, and the cities, the big ones? Yeah,
good question. I mean, the community banks are very unique in the U.S. economy. Few other developed markets have that construct, right? They are deeply embedded in their local communities. They have extremely strong relationships with their customers. I don't want to present a very idyllic picture, but very often the lenders went to the same school with their customers. Their kids play together. And these customer relationships are very sticky. You can appreciate on the backdrop of the news flow from the past few weeks how important sticky relationships are. And my favorite anecdote about the resilience of the community banks, probably, you can go to the pandemic, right? heart of the US economy stopped in March of 2020, and the government had to put enormous amount of stimulus into the economy to restart small business. And the way they did it is through the stimulus program, the Paycheck Protection Program, which was disbursed through the banking system. So in the course of just 2 weeks, in March of 2020, the US government put $350 billion into the small businesses. That amount eventually grew to about $800 billion. and that money that came into the small businesses, again, was placed through the banks. The banks were not taking any credit risk. The banks were making 5% placement fee on those loans. And if you're a bank executive, this is your dream business, right? No credit risk, 5% placement fee. And you'd imagine that the big banks, with their brand recognition, customer outreach, would be able to capture a very significant part of that fee pot. And actually, the big banks were totally out-hustled by the community banks. The community banks, they only have about 15% of the assets in the US economy. They ended up making 60% of these first round of paycheck protection loans. They were punching well above their weight. And the reason is they had a Rolodex of the customer relationships. They knew where the small business was. They could reach out to them. And that's not how the JP Morgans of the world are set up. So the customers, they want community banks. For the same reason they like to go to the mom and pop restaurant, the local coffee shop, rather than to Starbucks. Regulators, they also want community banks. Remember, for the last 15 years, the regulators have been working really hard to diversify risk in the system. They don't want to have more systemically important, too big to fail financial institutions. And I think if it's a business model which is both wanted by customers and supported by regulators, it is going to be a business model that survives and thrives.
Drago, you and I love to read the Financial Times, among other sources of daily information. And I saw an article in there and another one in the Wall Street Journal saying it was a strategic plus or a strategic advantage of the United States that they had this system and network of community banks, unlike certain countries, maybe in Europe, other places that don't have this. And you do not have this source of knowledge and capital and expertise and relationship at the local level. And therefore, you don't get companies started and you don't get the small and medium-sized companies nourished financially. And you and I know that 2/3 of all the jobs created are created by small and medium-sized businesses. Is this a strategic plus of the United States, the community bank network, the community bank ecosystem?
Yeah, absolutely. Absolutely. And it is one of the biggest competitive advantages of our economy, right? Because like in any other business, the more competition you have, the better the outcome for the customer. And the customer, in this case, being small communities, small businesses, they're much better off when they're banked by a multitude of smaller lenders with local presence, rather than being subject to oligopolistic pricing and a handful of big systemic institutions like Canada, I would argue, Australia have very concentrated banking system, and the price of credit there is a lot higher than the average price of credit in the US. So more competition is always better for customers. And I think the regulators very much want to have a thriving system of community and regional banks.
That's certainly been, I think, some of the things voiced by a number of the political and regulatory giants that they want to see. They want to see this system flourish, and they want to see this system healthy. Now, this backdrop that we've seen in the last few weeks. I mean, here's a headline from the Financial Times over the weekend that UBS is going to acquire Credit Suisse after frantic weekend talks. Then you have yesterday morning, the Credit Suisse bond wipeout threatens the $250 billion market. And that follows the Signature Bank and the Silvergate, and then, of course, the Silicon Valley Bank. What can you help us place this in some perspective, Drago, given your quarter century exposure to this? What are these isolated? Are these isolated, or is the system in any sort of fragility or danger? That's what I think many people are thinking about as we approach a new day here in financial markets.
Yeah, it has indeed been a wild couple of weeks. I think I ran out of my limit for using the word unprecedented during the pandemic 3 years ago. So I'm not going to say unprecedented anymore. I'm just going to say wild and unusual. But a lot of people have turned armchair bank analysts over the last couple of weeks, and there's a lot of noise. And I think it is important to sift through that noise and see exactly what happened so we can draw the right conclusions. And I think what happened is simple. The liquidity management models of a handful of select banks with very unusual businesses blew up. So think about how a bank works, right? They take your money on deposit, they keep some around in cash, and they lend the rest out. And the magic trick of banking has always been to figure out exactly how much do you need to keep around to fund the deposit withdrawals and how much capacity you have to lend. So go back to 2020, the pandemic, right? The US government prints $5 trillion to stimulate the economy. And the deposits in the US banks during 2020 and 2021 rose by $5 trillion. Now, before that, it took them the whole decade to raise $5 trillion of deposits. So in just 2 years, the banks got a decade worth of deposits. And the big question the bank should have been asking back then is how much of that is real deposits? How much of that is real savings that would stick around? And how much of that was just stimulus cash that was parked for a few quarters, maybe a business that was waiting for its supply chain to reopen, maybe a restaurant waiting to expand when customers returned, maybe an individual that was just waiting for rates to rise and put their money in money market funds. Our estimate, based on if you just take money supply growth, the saving rates, etc., is that about 3 trillion of that 5 trillion of deposits is not real savings. It's just temporary cash parked on the bank balance sheets, and it will leave the system. So it's about 60% of what came in. And that unwind started mid last year, when the deposits in the US banks started to decline gradually. And for the system as a whole, this is not an issue. It is less than 15% of the overall deposits in the system, but it has become an issue for select few banks because the liquidity in the pandemic didn't flow evenly. The banks that experienced the huge deposit inflows are now the ones experiencing the huge outflows. I guess they assumed the money was theirs to keep, that it was real deposits, and that was a grave mistake. Just look at the names that are in the headlines now. So Silicon Valley, their deposits grew up threefold from 60 billion to 180 billion. First Republic deposits, they grew twofold from 90 billion to 180 billion. Signature, more than twofold from 40 billion to 90 billion. Banks don't grow like that. Like our community banks, in the meantime, they grew deposits 25%. So the deposits of these hyper growth banks, they're not real savings, they're not sticky deposits. In banking, there's a saying that's been around for a long time: if it grows like a weed, then it likely is a weed. And these hyper growth bank deposits are normalizing, and they're finding that they underestimated their liquidity needs because they underestimated how quickly these deposits would run off. And I think the liquidity planning tools that Silicon Valley Signature used, they just did not reflect the reality of their balance sheets. In my previous life as a bank executives, we used to sit down in the boardroom and run to liquidity planning scenarios. And what we were using was, for example, the failure of IndyMac. 15 years ago, at the beginning of the global financial crisis, it was one of the first banks to fail. The deposits dropped 8-9% in a month. And that was one of the biggest runs a bank had experienced in history. And people were building their contingency planning, their liquidity planning around that example. But back then, the likes of IndyMac had about 60% insured and 40% uninsured deposits. So basically, you were budgeting in your liquidity plan for about 25% runoff of the uninsured deposits, 10%. And these hyper-growth banks that have failed recently, they had 90% uninsured deposits And of course, when they got hit with withdrawal requests, that was for about 20-25% of their total deposits. They just didn't have that kind of liquidity on hand because they never thought they would need it in an afternoon. So again, it's important to recognize how unusual Silicon Valley and Signature were. They get chunky deposits, 90% uninsured. And if you compare this to a typical regional bank, it has about maybe 50% uninsured. In the community banks that we invest in, about 30 to 40%. I had never in my career before seen a bank with 90% uninsured deposits. So we don't think it's systemic. One of the best advice that I ever got was when the going gets rough, don't read headlines. Talk to your banks. And that's what we've been doing for the last couple of weeks. We're talking to the small banks. And the feedback that we're getting from them uniformly, is it's business as usual. 25% of the banks that we speak to are telling us they are actually seeing new account openings, deposit inflows. For about 50%, it's deposit flat. And maybe 25%, 1 out of 4 is seeing some modest outflows, but those are typical for the season. Right? It's tax season now, David. We have to pay our taxes to the federal government in a couple of weeks. So people are writing checks to the IRS, and that's fairly typical for the season. And all of our banks are trading at or above budget. And the reason is I think these community banks have the extremely granular deposit bases. Only 30 to 40% at most are uninsured, and those are sticky relationships. We talked about it before. We're not seeing any liquidity issue in the community banks in this market. You want to own simplicity rather than complexity, and the community banks have very transparent, very simple, very stable balance sheets. But the investors, right now they're like the proverbial cat, which after it's set on a hot stove, will never sit on a hot stove ever again, but it won't sit on a cold stove either, and it just won't like stoves. So the investors got burned.
Go ahead.
The investors got burnt at Silicon Valley and the Signature and others, and they just don't want to hear about community banks or any other banks. There was a talking head on CNBC last week who proudly proclaimed, "I will never buy a bank stock again." And as a result, the community banks are trading at 1-time book value, at 7 times earnings, and normally they trade at 14, 15 times earnings. You can double your money if valuations revert to their historical averages. And even if the banks just trade up to where they were on Thanksgiving 4 months ago, it's a 40% gain. And on the downside, if you're buying them at book value, liquidation value, that book value really protects you. And we like that risk-reward profile very much.
This is very compelling, what you just spelled out in terms of valuation, in terms of being able to access a financial stock at a very, very good price and good price earnings ratio. How about the government response to this crisis, to these various bank issues that have come up with Signature, with Silicon Valley Bank? Okay, what at Silvergate? What is your thinking about, and the community bank community? Okay, the community bank ecosystem. What is your feeling about the quality, the depth, and the implications of the response that's happened to this? You're saying it's a pretty isolated group. The most amazing thing you've said to me, and you've said many amazing things to me over the years, but you're telling me IndyMac Bancorp, that everybody went crazy over about an 8% outflow, and you've seen 20% outflow. Am I right in some of these things? And it's a much more severe thing. But the government's response, we'd love to hear, given your experience, your knowledge of the industry and the regulators. How do you assess the implications and the fallout from what they have actions they've taken, Drago?
Yeah. Look, the U.S. government is very good in fighting issues that have surfaced. I don't think they're very good in anticipating issues, in preventing issues. But when the house is on fire, they come in with a big fire hose, and they're very, very effective. And the regulators, they didn't anticipate that any bank in this country could ever lose 20-25% of its deposits in a day. I don't know many people that did. It never happened before, not even close in magnitude, right? The biggest loss before was IndyMac 10% in a month. So the government was not ready. But now that we have two failures on hand, they are ready, and they're ready with the big fire hose. And the repo facility they put in place last week, which basically allows banks to take the securities on their books and go and get lending. They can repo them with the government at par rather than market value at a very attractive rate. I think it takes the liquidity risk off the table for a lot of banks. You're not going to see midweek failures. I think we're back to the blocking and tackling of analyzing banks. Who is going to grow loans, by how much, what credit issues might surface in a slowdown, potential recession. But I don't think you're going to see any failures that are driven by liquidity issues, because the government just addressed this with that liquidity facility. And I think the market is a bit slow to absorb this in the pricing and its interpretation. If you just go back to October 2008, right? We got the round of TARP passed through Congress the first week of October, which put $200 billion into the banks, another $600 billion into non-bank companies, and in many ways backstopped a lot of the risk. 2 weeks later, Warren Buffett, he got it, published an op-ed in the New York Times saying, "Buy American, I am." The market proceeded to drop for another 5 months and lose another 20%. So when the government puts some decisive programs in place, I don't think market participants are necessarily very fast to recognize that. But I think that the issue here has been largely addressed. You're not going to see liquidity-driven failures. You will see, I think, orderly restructurings of balance sheets and recapitalizations, like the one that First Republic, for example, is going through. And I think that the regulators are very efficient in fighting issues, again, that have surfaced. I think a bit longer term, there's going to be a fair deal of regulation coming now to address the new reality of bank liquidity, right? For the last 15 years, regulators have been fighting the credit issues from the global financial crisis. I think for the next 15 years, they will be fighting bank runs. So I expect a lot greater focus on a percentage of uninsured deposits, the liquidity reserves that are kept against them. I also expect a lot more investor disclosure on deposits. But again, when we go to the community bank space, the community bank balance sheet today is not that different from where it was 15 years ago, right? Their business model hasn't changed. They still have this mix of 60% insured, 40% uninsured deposits. So I think a lot of this regulation is going to be targeted and is going to hit bigger banks with more complex business models. And I think that the community banks will probably be largely unaffected. But let's suppose, just suppose that you take that new regime that might come into place for the larger regionals, and we apply the kind of liquidity reserve ratios that apply to the systemically important banks. So let's take the framework under which JP Morgan is regulated and applied to a community bank. They will probably have to slow down loan growth. They have to put some more liquidity on their balance sheet. And we think they might take a hit to earnings, but that hit to earnings we estimate is going to be maybe high single digit, low double digits. So if you're talking about a sector that's trading at half its historical multiple, and earnings take, let's say, 10% hit because of new regulations and liquidity requirements, you still have 100% upside. So the market is pricing a 50% correction to earnings. We don't think that's going to be more than 10. And I think that's the big disconnect.
Drago, 2008, July of 2008 was IndyMac Bank Corp. And today, here we are in 2022, 14 years later. And before we move on, I'd love to get your thoughts about the implications of this new regime for the economy, especially the economy that these community banks are involved in, that they're intimately parts of. However, before that, this thing here, we did not have in 2008. We did not have the smartphone. That was basically the iPhone really came in around 28, 29, 2010. And these bank runs that you just used that word, I see the media, I see people perhaps almost in an irresponsible way, calling out and getting people upset, getting people anxious, getting people nervous. That almost that you could call it the Elon Muskification of news. Okay, where people can go out on this through different social media channels, and I'd love your thoughts about this element of it as we then go into the implications for the economy of this. Perhaps a more measured, a more paced credit expansion or credit standards being lifted, and perhaps taking slower decisions in terms of extending credit. So your thoughts about this first, and then secondly, the economy.
Yeah, of course. So of course, now everybody has a bank branch in their pocket, effectively, and I think that certainly impacts the deposit gathering business of the banks that have big consumer focus, right? And these would be the cities, the larger national banks. The community banks, again, they're very relationship focused. Very few deposits come in there because of a few taps on a phone screen. These are people that call in, walk into branches. It's old school banking, simple banking. And you can see it now in the stickiness of their deposits over the last couple of weeks, right? Money that did not come into the bank with a tap on a phone screen is not leaving the bank with a tap of a phone screen, right? So relationships above everything else. That's the competitive edge of these community banks. And again, the money came with a phone call and a visit. It's not going to leave until people make a phone call and a visit. And again, what we're hearing from the channel checks in our community banks is overwhelmingly it's business as usual. They might get 10,000 phone calls, and of those, maybe 20 would be on deposit insurance and deposit limits. The rest is all about their normal business. And
I think that's one of the most underappreciated elements of the strength of this sector as an investment locus or focus, is what you just said, is that it's relationships, it's in person, it's visually seeing where you're extending credit to, knowing these people, your kids play together. This is a very different thing than the flightiness of social media driven flows. Am I right?
Yes, absolutely. It's very, very relationship driven business, and it's very local. They know their customers.
Can we move now to the effect on the economy? How do you feel this is going to affect the economy from your standpoint as a longtime analyst, participant in the banking sector? How's this new, I don't know, strictness, I don't know, this new regime, how is this, not only what's been announced, but what's maybe likely to come? How's this going to affect the economy, Drago?
Well, I think in the immediate term, liquidity is going to reign supreme, and banks are going to slow down lending until they figure out how much liquidity they have, what regulators will ask them to keep in terms of additional liquidity. So I think lending is going to slow down, and when credit is tight, a recession usually follows. So it is quite possible that the recession starts this month or next. And David, you've written so many books on the subject, right? About the business cycles and the market cycles. Recessions, they last 10 months on average. The playbook has been quite consistent. Recession lasts 10 months. The equity market tends to bottom halfway through a recession. So if the recession is about to start now, you might see some broader broader-based equity market bottom sometime in September, October. But the community banks, much like the other banks, they lead on the way down. We've dropped 35% in the past month, right? They lead on the way down and they lead on the way up. So it is possible that they might actually turn around earlier than the rest of the market. And we don't try to pick exact market bottoms, but we just have very high confidence that if you leg into a carefully picked community bank portfolio between now and 4 or 5 months from now, is going to be a great entry window. And again, markets have been selling off since late 21. These things eventually end. Even the worst corrections haven't really lasted more than 2 years. So we're probably closer to the end of the correction. And again, if you're buying these banks at 1-time book value, at 7 times earnings, half their normal multiple, you can do extremely well.
I like this attractively valued. They tend to lead, and so this is an entry point. You're saying that's setting up with a recession likely, if I'm understanding you correctly, that you're going to get. You've already gotten the price move. Am I hearing you correctly? We've already gotten the price move to make these even more attractive at these 7 times multiple kind of valuations. And the other part was if they do have a 10% drawback in earnings because of the recession, that you basically have you still have 100% price appreciation potential if they go back to historical multiples. Is there any risk? Could that 10% be more? I think people would be asking that. Could that 10% be more, or is it pretty much of a contained scenario for the community banks because they're not exposed to some of the things globally in the capital markets divisions of these big banks?
Well, credit is always a risk, right? If you're a bank analyst, that's where you always start. I don't think that there are many blind spots in credit. I mean, the Federal Reserve, the regulators have been focusing on credit for the past 15 years. And just when you think about the way that the Fed stress tests the SIFIs, they have extremely robust tests. They have, for this year, for example, 10% unemployment, 12% GDP contraction, 45% stock market drop, and 40% correction in real estate prices. So before a JP Morgan or Bank of America is allowed to pay a dividend or buy back a single share of stock, they have to prove to the regulators that they have robust capital to withstand this stress test. And you're going to say, well, this is for the SIFIs, but it does trickle down to the small banks because the regulators of the small banks, they look at their portfolios and they say, well, I know you're not supposed to do this, but wouldn't it be nice if you did something similar? So I can assure you that the spirit of that regulation does trickle down to the small banks. And that's why you see the capital in the banking system now at 60-year highs. And of course, recently there has been a lot of talk on how for the smaller banks, the marks on the securities portfolios are actually not subtracted from capital. They are for the SIFIs, but not for the smaller banks. And I think that's going to be one of the parts of regulation that might change. But even if you stress test the portfolios of these small banks for embedded securities losses, capital goes from 8% to something like 7.25%. And even if you take a haircut on that for credit losses in the recession of 1%, maybe 2% loan losses, the small banks are still extremely well capitalized. The Feds want them to stay at about 4.5% of the holding company level. So you're well above that level, even in extreme stress. And I think it's also important to recognize that the small banks have a lot of collateral behind their loan portfolios. It's been a fairly controversial topic. The Financial Times a couple of weeks ago ran an article saying big problems with small banks. And their argument was that a third of the balance sheet in the small banks are in commercial real estate loans, and only 10% in the big banks are in commercial real estate loans. So they said it is bad for the small banks. I would actually argue that it's a good thing, because when you think about the big banks, if only 10% is backed by real estate collateral, what are the rest of the loans in? These are leveraged loans, unsecured consumer loans, right? It is good in an inflationary environment to have collateral behind your loans. If you look at the 1970s was the best decade for credit in the banking system in the US. If you're a bank credit officer, you experienced your lowest loan charge-offs in the 1970s because inflation was propping up real estate prices, and these real estate prices were serving as collateral behind loans. So I would argue if you're going into an inflationary recession here, your best bet is loans and institutions that make loans that are backed by real estate.
Now, turning to the investment part of this, the investment thesis part of this, you talk to a lot of people who consider investing in community banks and in adopting this strategy as part of their asset allocation. What are investors missing here right now as you go out and you talk to people and you interact with people? And how do you select your investments for the portfolio that you're managing, Drago?
I think there's absolute apathy in the generalist investor community towards banks. If you just look at portfolio weights at the end of last month, they were about 40% underweight the sector versus benchmark allocations. That's probably gotten worse with the news flow from the last couple of weeks. When you go to bank conferences, you don't see generalist investors anymore. You don't see mutual fund investors. And that has usually been a terrific entry point for the sector. You really have to go back and only see such environments in the global financial crisis and during the pandemic. So great apathy, very severe underweight from a lot of generalists. And I think, when you construct a portfolio for the new interest rate environment, Naji and I have been thinking a lot about what is going to work now in the next decade with high interest rates. We think is going to be exactly the opposite of what worked for the past decade, right? When rates are high, you want to own the lenders rather than the borrowers. You want to buy value stocks rather than growth stocks. And history shows that small cap stocks work better than large cap stocks. And these community banks, they just have this perfect intersection of these three themes, right? They're lenders that are value priced, and most of them are small caps. So it is actually a perfect investment for a cycle of high interest rates. And because of just the current news flow right now, it is very underweight by generalist investors. And I think eventually that interest is going to get restored. People will come back into the sector. If you just look at the last 7 years, right, the S&P earnings have gone up 90% over the last 7 years. The S&P price has gone up 90% over the last 7 years. And you know about the KRE, the regional bank index? It is flat. It hasn't moved for the past 7 years, even though the bank's earnings in the KRE have gone up 100% more than the S&P. I think that gap is going to close when investor interest returns.
Drago, we promised people that we would try to keep this to an hour or a little bit less than an hour. We're going to check and see what kind of questions have come in. And while we're doing that, one question that did come in a little bit ago was, do you see value in European banks, and how would you compare the situation there? European banks, would you invest there? And at the same time, financial technology companies, financial technology, will they disrupt traditional banking, either in the US or in Europe? So we'd love your thoughts there.
I think there is a big difference in the structural profitability of European banks versus the US. If you take a residential mortgage loan, right, this is the simplest kind of loan that you can make, the lowest risk kind of loan, lending somebody 70, 80 cents on the dollar to buy the home where they're going to live. In the US, these loans are basically guaranteed by several government agencies and placed to the securitization market. In the US, you do not find residential loans on the balance sheet of the banks. In Europe, you do. Same thing for high-grade corporates, right? We have extremely functional, very well-developed bond market here. High-grade corporates don't get bank loans. They go to the investment grade issue market. In Europe, a lot of them do get financed by the banks. So as a result, in the US, our banks structurally make riskier, high return, high risk loans than the European banks. And as a result, they do have high returns on capital. So if you get high returns on capital, eventually you do end up with a higher stock price. And if you just look back since when we started investing in community banks in Petiole 11 years ago, the prices of European banks basically haven't moved, and the prices of the US banks have doubled because they have much higher return on capital. So my guess would be if you're investing for the next 10 years, I'm not saying that you cannot make money in European banks on a trading basis, but if you just want to passively buy and hold a portfolio for the next 5-10 years, the system with a high return on capital is going to generate high return to investors, and this is the US. And in terms of fintechs, I fundamentally believe that the franchise value of a bank lies in its deposit funding. And you have seen this more clearly than ever in the last couple of weeks. And that's the essence of the banking business. When Fed funds is at 5%, if you can borrow at 2 to 3 in a bank and make a high quality commercial loan at 7%, you capture a very nice spread. Now, if you're a fintech without depositories, without a banking license, you cannot borrow at 2 to 3%. You have to go and take wholesale money at 5%. You can't make a loan at 7 if you're borrowing at 5 and make a spread. So the fintechs, they have to go way out on the risk curve into consumer loans, subprime, and I think this does not generate very attractive risk-adjusted return on capital. So again, I think in banking, your value of your franchise is in the quality of your deposits. I don't think that fintechs will be competitors to banks. They will be friends. I would expect a lot of businesses to actually evolve to partner with banks and provide them with process solutions, technology solutions that actually save them costs and save them time and make the banks more efficient. And I think that this is probably going to be the best model for fintechs, being partners with banks rather than competitors to banks.
2 more questions have come in. First is your thoughts on return on equity as compared to return on assets. How we need to look at these 2 measures of banking. Our friends Warren Buffett and Charlie Munger have always stressed long-term return on equity is going to approximate long-term return from holding a stock. How about in your sector, in your realm, in your part of the world, return on equity versus return on assets? How is it now? How is it historically? And how should we be analyzing and looking at this measure?
Yeah, absolutely. So, and that was the point I was making earlier about why you probably over a longer to intermediate time horizon prefer to hold the US over the European banks. The structural return on equity in the US is just higher than the structural return on equity in Europe. Here you're talking about mid-teens through the cycle. In Europe, you're talking about high single digits to low teens, and stock prices, of course, do follow that. So very simply, over multiple cycles, the banking system rebalances in the US to earn somewhere between, let's say, 13 and 15% ROE. And over long cycles, the stock prices should follow, as Mr. Munger says, 13 to 15%. That's, I would think, kind of a structural return long-term for holding the industry as a whole.
You do notice that he has Bank America, just to take an example. We're talking about community banks here today, but one of his largest holdings, and it's been a great winner for him, has been Bank America, and he held Wells Fargo for decades. So Buffett tends to like U.S. banks. And you're telling me if you like U.S. banks, there's a special sector called community banks where you can really, I think, protect yourself through valuation and through the way this business model is. And it's not subject to this. This is the message I'm getting from you today, Drago.
Yes, and with a lot of downside protection, right? Because ultimately, we are focused on managing wealth for high net worth individuals, where always the number one objective has been the preservation of wealth. So for us, downside protection has always been where we start our analysis. And what we like about the community banks is that they're trading right now around book value, which is basically the liquidation value. If you take them and you run off the business without generating any new revenue, just run off the business, is going to be worth right around the price that we're paying for them. So in a turbulent time like this, you get a lot of downside protection from buying them at book value. And then, of course, you think about the earnings, what they're going to be like. And the multiple is half the market multiple. You can double your money. What we like about it is not just the fact that we can double our money here, but we can double our money with a lot of downside protection from buying them at book value. That asymmetry of risk versus return is something that is very appealing to our firm.
This point, which you just stressed, the protection and the risk management, risk awareness of investing, I think is one of the things I've noticed in knowing you for years and observing you. Now, Petiole has had a reputation in Switzerland, in Europe, in the region of Middle East and elsewhere as a private market specialist, private equity, private credit, private real estate, and they've really carved out a special niche in these markets. How does this community bank's investment approach and investment from an asset allocation standpoint, how does it fit within this specialization concept of and philosophy of Petiole?
So, the roots of Petiole were not, and the family office were not as a private investor, right? The firm was not started with the intention to make private investments. The firm was started with the intention of making the best risk-adjusted investments for families. So at its beginning, Petiole was actually, and family office were running liquid portfolios. And over time, the founder of the firm realized that actually the best risk-reward profile is to be found in privates, and the firm migrated to privates. But it is not like we have a mandate to invest in privates. Our mandate is just to find the highest Sharpe ratio investments where we get the biggest risk-adjusted return. So the community banks, they very interestingly fit this profile, even though they have tickers and they're listed. When you look at because of this downside protection, right, from book value, they have tended to exhibit a lot lower volatility on the downside than public banks. And if you just look at what the market has done from the beginning of the year, the regional bank index, the KRE, is down about 25%. The community banks that we invest in are down about 10-11%. So we're down less than half our benchmark index. And that is a feature that our firm likes very much, right? It's exactly the same thing that we look for in private equity investments. Well, you do make money when the times are good, but when times are bad, you want to draw down a lot less than the market. And in some ways, you can think about that community bank portfolio that we have in Petiole as investing in a private equity-like risk return model with a lot lower drawdown than the public market, in a model where you don't have to sacrifice liquidity as much. You do have tickers. So these small caps, they behave like private equity in terms of Sharpe ratios, even though they have tickers, and that's very attractive for our asset allocation model.
I thank you very much for the insights, the wisdom, the experience that you've shared with us today. We want to thank all of our viewers and participants on today's webinar, and we look forward to more discussions and analysis. And I look forward to being with you and learning from you and exchanging views. This has been just tremendous today, Drago. Thank you very much. I'm going to turn it back to our technical people and thank everyone for joining us today. And we wish everyone a Ramadan Mubarak and a very happy beginning of spring.
Thank you, David, and thank you to all of our listeners. It's been a pleasure and an honor.